Hello and welcome to this MHA update webinar on the Supplementary Bulletin to the College Accounts Direction 2020-2021. My name is Stuart McKay and I'm a partner at MHA McIntyre Hudson. The Supplementary Bulletin was issued by the ESFA on the 16th of July 2021. The bulletin itself has the same status as the College Accounts Direction and the Post-16 Audit Code of Practice, and it should be read in conjunction with these two documents. This isn't the first time that the ESFA has issued a supplementary bulletin. Indeed, one was issued in 2020. That 2020 bulletin is still in force and we will be covering its contents as part of this webinar, but we will largely be focusing on the 2021 bulletin. Okay, so let's first up take a look at last year's bulletin. As I mentioned before, this still remains in force. It's fair to say that a lot of the text in last year's bulletin has made its way into this year's bulletin, so there is areas of duplication and hopefully familiarity. The bulletin itself is to be used by auditors and colleges. The scope of the document is fairly wide-ranging. It covers areas such as regularity assurance, new questions that are added into the regularity self-assessment questionnaire, areas that auditors may want to consider in terms of the operational of key financial controls under COVID environments, how colleges have applied regulatory notices such as the PPNs. Then it moves on to areas for further consideration such as going concern assessments, points to be added into the trustees report, and areas of technical application such as how to account for certain COVID support that the college may have received. So let's move on to the 2021 bulletin. And as I mentioned, the last year's bulletin is still in force, but I think there's nothing in there that isn't already covered in the 2021 bulletin, so we'll go through this in a lot more detail. There are 7 parts to the bulletin, a brief intro giving you essentially the application of the bulletin and its regulatory force. Then it goes into more detail, as I mentioned there, talking about regularity and audit implications, bits about financial sustainability and going concern, some disclosures that are suggested that be part of the annual report. Then, as I mentioned before, we've got some accounting considerations for COVID support. We've also got a new area of consideration, specific accounting considerations in part 6, which largely deals with accounting for laptops. And part 7, actually, I'm not going to cover because all that points to is some potential further guidance that the ESFA may issue on a timely basis. So part 2 of the bulletin covers regularity and audit implications. The first item it covers is to clarify that the scope of the audit and regularity assurance engagement remains unchanged, and that any COVID funding actually is encompassed within that framework. It then points you to consider essentially that as COVID has gone on throughout the year, there may well be areas of concern that might arise when dealing with regularity assurance, and this is to reflect that key financial controls may well have had to have been adapted or altered in order to cope with remote working. So it's talking here about whether internal audit the plan has been carried out as it hoped to, whether there's been any issues in that, whether there's been any gaps in assurance as a result, whether management accounting information has been prepared on a timely basis, if governors have met in accordance with their timetable, and certain things to consider there. The next point is around the regularity self-assessment questionnaire, and this reflects the new questions that were listed and included in last year's, the 2020 self-assessment questionnaire, those have continued and remain. So the new questions, and there were 4 of them that were included in the 2020 self-assessment questionnaire, remain. They're exactly the same. In summary, what they include is the application of the PPNs. This is the public procurement notices, ensuring that the college, maintains its supply chain and retains value for money, and whether it's taken action such as paying suppliers for services that may not have been undertaken. The classic example being examination fees, payments that are entitled to be made under these procurement notices. And so what the self-assessment questionnaire asks colleges to do is to talk about how they have applied the PPNs, what work they've done to ensure that the college hasn't double funded any of their suppliers and so forth. The next question on the self-assessment questionnaire is to do with CJRS funding, which is the Coronavirus Job Retention Scheme, so furlough funding essentially. And the questionnaire looks at how the college has complied with the eligibility of the rules, what it's done to ensure that it was entitled to make the furlough claim, to ensure that essentially any double funding risk has been mitigated. There's also another question about more wider COVID-related funding and how those funds have been applied, the spending of those. And finally, whether there's been any interruption to internal audit services. The next part of this section looks at essentially where auditors need to consider certain aspects of the audit, and this is where judgment may come into play. So again, it's asking auditors to take account of a range of factors in deciding their approach to the audit, and this falls back on some of the points I mentioned before, such as if there's been any changes to the financial control procedures in place. Does the audit need to reflect those changes? Has risk increased as a result? And looking at essentially the oversight, governance arrangements, how those were affected, and how proactive the college has been in order to address that, and what essentially documentation of the decisions being made has been undertaken. I also talked about in the self-assessment questionnaire, there's a talk about the PPNs. Again, the bulletin talks about essentially in a bit more detail here about what the colleges should have done in terms of managing public money, and what checks that they should have done over the payment of suppliers and so forth. So the bulletin covers that in a bit more detail. It also talks about and gives links to where funding rules have changed in AEB and apprenticeship funding rules, and gives links to the changes in the funding guidance there. Part 3 of the Supplementary Bulletin deals with financial sustainability, and in the auditor's eyes this sort of focuses largely around the going concern assumption. Here the bulletin is ensuring that the college is undertaking key considerations when assessing financial sustainability, and what it's expecting the college to look at. And it lists a series of bullet points, such as looking at scenario planning, sensitivity analysis, impact on KPIs and funding streams, for example, how the availability of external finance, any government assistance that could be received, and then reflecting on whether any of the accounting estimates or there's any implications for the carrying value of assets. So this is the type of things that the bulletin is seeking that colleges undertake as part of their going concern review. It's also worth noting that auditors' responsibilities in terms of going concern have been enhanced this year. There is a revised ISA out there. ISA is an international standard of auditing. ISA 570 is a revised ISA on going concern. This has an implication in terms of the auditor's report. The auditor will now this year provide a positive conclusion on going concern, and the ISA itself details further work that the auditor has to do in terms of coming to that conclusion. So that's one just to take note of. The bulletin also makes specific reference to bank borrowings and loan covenants, and this is a reminder to ensure that where conversations, where covenants have been breached, conversations are had at an early stage and waivers obtained where possible. And this is to mitigate the likelihood that if a breach occurs, that the loan may become, for accounting purposes, repayable on demand, which will affect current ratios and so forth. Again, there's a push in there that says if covenants are breached, there's a recommendation that disclosure is made within the accounts to that effect, and also recognising that conversations may well still be ongoing, but essentially what the bulletin is saying that an assessment should be, or narrative should be included within the going concern assessment to that effect. Part 4 deals with annual report disclosures. Again, if we go back to the 2020 bulletin of last year, it pointed towards the guidance that the Charity Commission had issued, suggesting that enhancements should be made to the annual report, the narrative within the annual report, detailing some of the effects of COVID on the college. Again, the reference to the Charity Commission guidance remains, although I would say there's a slight change of focus within this bulletin, where it's actually picking out some of the key bits that it would expect a college to make reference to. So those are financial review, obviously the impact there of COVID on financial performance, and interestingly, the impact on the reserves policy and the level of reserves. It specifically mentions too, and I think this is an area where essentially the ESFA are looking for enhancements here to colleges to explain a reserves policy and the level of reserves held, and that's particularly important essentially going forward as well. There's also a suggestion that going concern, essentially in the assessment of going concern within the annual report, there will be talk of the uncertainties ahead, and that those uncertainties will include non-educational activities such as trading activities and so forth. So explaining essentially the unknowns in the future that may have an impact on going concern. It's also suggesting that you make reference to the impact on the governance framework, if any, and how essentially the governance of the college has continued throughout the period under COVID conditions. It's also suggesting that you may want to include any positive impacts, not just negative ones. If there's certain ways of learning or changes that have been made during this period, colleges should applaud those and make reference to them. Section 5 of the bulletin deals with the accounting and auditing implications of financial support that may well have been received by the college. Essentially, the auditing implications here, there's nothing necessarily new here. This will follow international auditing standards, but where essentially you will have COVID-specific funding, the auditors will need to look at the application and the expenditure of those of that funding, essentially in line with the rules in which the funding has been granted. The types of funding we're talking about here are actually listed in Annex A of the bulletin, but just as a summary, these are provider relief schemes, free student meals, 16 to 19 tuition, high value courses for school and college leavers, the COVID-19 Workforce Fund, traineeships, mass testing funding, National Skills Fund, and any sector-based work with academies. So, as I say, Annex A details the sort of main sources of COVID funding in which this section is really dealing with. Section 5 also covers what the bulletin is expecting in terms of disclosures within the accounts. So again, so here we're talking about materiality. So materiality here is essentially looking at what the user of the accounts would deem to be important. So where it's saying if you have a material funding stream from any one of those funding streams that I mentioned before in Annex A, you should disclose it separately. It says specifically that CJRS, which is Coronavirus Job Retention Scheme funding, that must be disclosed separately regardless of materiality. So even if you've received £10 worth of CJRS funding, that needs to be disclosed in a separate note. That note actually includes is already in there. It's enhanced disclosure within the non-recurring funding note that's already within Casterbridge set of accounts. So it's just an added bit in there. It's then suggesting that if you have a material level of funding from one of the other funding streams within Annex A, you ought to disclose that separately as well. When looking at materiality, it says you do need to consider the public interest there. So it's not just necessarily a financial statements materiality that your auditor might set. You need to be considerate of the nature of the funding here. So I think there's a push here for disclosure of any such COVID-19 support funding that comes through, obviously with a de minimis for immaterial or trivial items there. It also says that don't just focus on income funding. The college may well have been in receipt of loan funding or cash flow support, which wouldn't necessarily go through income. There's a must in there that the bulletin says that the college must detail where material the arrangements that have taken place. Section 6 deals with some specific accounting considerations under COVID. There are two issues in here. The first one is regarding laptops. The second one is about operating leases. So the first one, accounting for laptops. This is where the college has either been gifted or in receipt of laptops, which is then given out to students. The issue here is there will be different circumstances under which the college has received the laptops, and so the ESFA are concerned that there may well be difference or differing accounting treatments. So it's outlined sort of expectations of the various possible options. So the first one is to understand is whether the college is acting as an agent or a principal. As an agent, it's essentially this a new concept. So as an agent, you don't necessarily have discretion over the use of the laptop. So essentially, the funder has asked you just to distribute the laptops, in which case you have no control over the asset. And therefore you would not recognise this within the financial statements of the college, other than perhaps like you would do in terms of some of the bursary funding, as you put it as a note at the back of the account, if material, to say that we have or acted as agent in terms of distributing laptops and so forth. If, however, you do have discretion over the allocation of the laptops and therefore you are in control of the assets, then you're acting as a principal. And then there are just sort of two sort of mainstream ways in which this might manifest itself, is to whether you're actually giving the laptops or donating the laptops to the recipient, or whether you are lending the laptops. The difference between the two is where lending, the risks and rewards of ownership remain the college's. So therefore, if the laptop breaks, then essentially that would then be the college's responsibility to replace. Or if, for example, the laptop has been donated, essentially, so the college does not expect the laptop to be returned, then there'll be a different treatment. So If under the lending model, you would treat it as a fixed asset of the college, and therefore it would then be subjected to depreciation according to your normal accounting policies. If, however, you're donating the laptops out to the students, what you do is you recognise the income within your statement of comprehensive income, and then the opposing side goes as stock until you then distribute it to the student, at which point on distribution it is then expensed again through the statement of comprehensive income. Depending on how the laptops are given to the college, it could well be that they were gifted, so they're given free, at which point you're now dealing with a donated good. The principle here goes back to a charity concept, really, about valuation of donated goods, and at which point you recognise the value to the corporation. So that's not necessarily the market value of the laptop, it's what the college would have paid for that laptop. So there is an element of judgment in there. So you may need to speak to your auditor about that if material. The other consideration that the bulletin has highlighted is regarding operating leases and a rent concession that may well have been negotiated during COVID. There's a clarification piece that's been put through FRS 102, the underlying accounting standard, which is then filtered through into this bulletin. And FRS 102 was simply clarified to say that where you have a rent concession that has been negotiated specifically because of COVID, then you would recognise that concession on a systematic basis over the period in which it was intended to compensate. So essentially, it's saying rather than spread it across the life of the lease, that you would actually put the rent concession over the period in which the concession was given or intended to be given. So that concludes the webinar session. I hope you have found that of interest. There are certainly a number of topics up there that may well warrant further discussion. So please do get in contact with your MHA representative, and the contact details are on that slide. So finally, it just leaves me to say thank you for your attention, and we hope to be in discussions with you soon. Bye for now.